welcome to our year-end market deep dive. We're going to be sifting through some recent data and expert insights.
Yep.
And see if we can kind of piece together what happened in the market as 2024 comes to a close.
Right.
Think of this as your morning brief.
Yeah.
Giving you all you need to know before the ball drops tonight.
Yeah, it is interesting, isn't it? How we can glean so much about the market's mood just by looking at a few key numbers.
It's like reading the market's tea leaves.
Right.
So, for instance, yesterday, less than 2% of S&P 500 stocks ended the day higher.
Yeah.
And just 58% are currently trading above their 200-day moving average.
Okay.
That's the lowest we've seen since October 2023. Does that tell us investors are feeling a little uncertain as we head into 2025?
The 200-day moving average is a simple technical indicator that a lot of traders use. When a stock price is consistently above this average, it's generally viewed as a bullish sign.
Okay.
And when it dips below,
Right.
it can signal a shift towards a more bearish sentiment.
Gotcha.
So seeing such a low percentage of stocks above this key level does suggest a certain level of caution in the market.
All right. That makes sense.
Yep.
But before we get too deep into technicals, let's zoom out and take a look at some of the economic indicators that came out this past week. We have quite a few, including consumer confidence, durable goods orders, new home sales, jobless claims, and the trade balance figures.
So these economic indicators are essentially snapshots of different parts of the economy, helping us understand the bigger picture.
Okay.
Yeah.
So let's break them down one by one.
All right.
First up, consumer confidence.
Okay.
What does this data tell us
Yeah.
about how people are feeling about the economy and therefore their willingness to spend?
Consumer confidence is a key driver of economic activity.
Right.
When people feel confident about their financial future, they tend to spend more, which in turn boosts businesses and the overall economy.
Makes sense.
Unfortunately, the Consumer Confidence Index showed a decline this past week.
Okay.
It seems folks are a little hesitant.
Right.
Maybe due to the inflation we've seen this year or concerns about a possible recession on the horizon.
So not the most cheerful news on the consumer front.
No.
What about durable goods orders?
Okay.
What are these exactly?
Sure.
And what does their performance tell us?
Durable goods orders track new orders placed with manufacturers
Okay.
for goods designed to last at least 3 years.
Okay.
Think big ticket items like appliances, cars, machinery, things businesses invest in.
Gotcha.
A decline in durable goods orders can sometimes signal that businesses are feeling a little cautious about the future and might be scaling back investments.
That does sound a bit worrisome.
Yeah.
How did the actual numbers compare to what economists were expecting?
The decline in durable goods orders was actually steeper than economists had forecasted, which added to the sense of unease among investors.
Okay. So 2 data points. And both suggesting some caution in the air. Now let's talk about the housing market.
Okay.
New home sales. Did they provide any relief?
Well, the housing market has been pretty volatile all year.
Yeah.
So any new data is closely watched. New home sales figures weren't terrible.
Okay.
But they didn't exactly paint a rosy picture either. Basically, the market seems to be in a holding pattern right now. Still trying to find its footing amidst rising interest rates.
So a bit of a mixed bag with housing.
Yeah.
What about jobless claims?
Okay.
Any good news there? After all, a strong job market is usually a good sign for the economy as a whole, right?
You're absolutely right.
Yeah.
And thankfully, jobless claims, which track the number of people filing for unemployment benefits, actually decreased this past week.
Okay.
This suggests that the job market remains relatively healthy for now, despite some of the other economic headwinds we've been discussing.
That is good news.
Yeah.
A strong job market can definitely boost consumer confidence and spending.
Right.
Now let's move on to the trade balance.
Okay.
What exactly does the trade balance measure?
Sure.
And what did the latest figures tell us?
The trade balance is simply the difference between a country's exports and imports. If a country exports more than it imports, it has a trade surplus. if it imports more than it exports,
Yeah.
it has a trade deficit.
Okay.
Now, the latest figures showed that the U.S. trade deficit widened more than expected.
And what does that mean for the economy?
Well, a widening trade deficit can have various implications.
Right.
It can put downward pressure on the country's currency,
Okay.
as well as impact domestic industries that face competition from cheaper imported goods.
Okay, so a lot to unpack there.
Yes.
It seems like we're getting a mixed bag of signals from the various economic indicators.
Some are flashing yellow,
Yeah.
while others offer a bit more reassurance.
Now, we've talked a lot about broad economic trends.
Yeah.
But let's dive into some specific data points that really caught my eye.
Okay.
Starting with the Chicago PMI. I hear this is a pretty important gauge of manufacturing activity.
Absolutely.
Yeah.
The Chicago PMI, or Purchasing Managers Index, surveys purchasing managers in the Chicago region about various aspects of their business, like new orders, production levels, and employment. It's considered a leading indicator of the U.S. economy and provides insights into the health of the manufacturing sector.
And what did the latest Chicago PMI numbers tell us?
Well, the Chicago PMI fell for the third consecutive month, hitting 36.9. Now, to give you some context, a reading above 50 typically indicates expansion in the manufacturing sector, while reading below 50 signals contraction. And this latest figure, 36.9, is a level we haven't seen since May of 2024. Historically, readings this low have generally only occurred during recessions.
So not the news we were hoping for.
Right.
What does this potential contraction in manufacturing mean for the broader economy? Could it be a sign that we're headed for a recession?
It's definitely a cause for concern, but it's important to remember that the Chicago PMI is just one data point. We need to look at it in conjunction with other indicators to get a more complete picture. That being said,
the Chicago PMI does align with some other data we've been seeing, like the decline in durable goods orders together. They suggest a potential slowdown in manufacturing, which could spill over into the broader economy.
So maybe not a full-blown recession yet, but certainly some warning signs flashing.
Exactly. We're in a wait-and-see mode right now.
Oh, well, let's move on to another data point that was making headlines this past week. The QQQ, which tracks the NASDAQ 100 index. It had a pretty wild ride on December 30th.
It did.
Didn't it?
The chart showed 3 near-perfect rejections.
Wow.
Of the rising trend line that day.
Really?
Essentially, the price tried to break through this upward trend line 3 times, but failed each time. And then it closed the day with a sharp drop.
I'm trying to picture that in my head. 3 times bouncing off that trend line. That does sound significant.
For those of us who aren't chart wizards, can you explain why this pattern matters?
In technical analysis, a trend line is basically a line drawn on a chart that connects a series of highs or lows, showing the general direction of the price movement. When a price repeatedly fails to break through a trend line, it can signal a potential shift in momentum. In this case, the fact that the QQQ couldn't break above that rising trend line might indicate that the upward trend is losing steam, and we could be seeing a reversal.
So it's like the QQQ was trying to climb a wall, but kept slipping back down. And now maybe it's decided to head in the other direction.
That's a great analogy.
Okay, cool.
And it's something investors should definitely keep an eye on. If the QQQ breaks below that support level, which is around 519 right now, it could signal further downside potential.
Got it. So a lot of uncertainty surrounding the QQQ. And the tech sector as a whole. Speaking of tech, I want to touch on something we talked about earlier, the softening prices. You mentioned that it connects to some news about Alibaba, the Chinese tech giant.
Alibaba announced that they were slashing prices for their large language models, or LLMs. LLMs are a type of artificial intelligence that can process and generate human-like text. And they've been a big area of investment and excitement in the tech world.
So what does Alibaba cutting prices tell us about the AI sector?
Well, some analysts see it as a potential sign that LLMs are becoming commoditized.
Interesting.
Basically, as more companies develop these models and the technology becomes more widely available, competition heats up, and that can drive prices down.
I see.
Yeah.
So it's similar to what we've seen with other technologies, where early on things are expensive and exclusive, but as the technology matures and more players enter the market, prices become more competitive.
Exactly.
Okay.
But with AI, there's an added layer of complexity.
Oh, really?
Because some experts believe that if LLMs become too commoditized, it could actually hinder further innovation in the field.
Hold on, explain that to me.
Okay.
How could lower prices and increased accessibility be a bad thing for AI progress?
It's a contrarian view.
Okay.
But here's the logic.
Yep.
If prices collapse, it could discourage companies from investing the massive amounts of money and resources needed for cutting-edge AI research.
Makes sense.
Why spend billions developing the next generation of AI if you can just buy a perfectly good LLM off the shelf for a fraction of the cost?
That's an interesting point.
Yeah.
So there's a chance that instead of continued groundbreaking advancements in AI, we might just end up with a bunch of really good chatbots.
That's the bear case scenario. And it's certainly something to consider.
Right.
If AI progress stalls, it could have ripple effects throughout the tech sector, potentially impacting prices.
Wow.
For everything from chips to energy.
That's a lot to think about.
Yeah.
So we've got potential slowdowns in manufacturing and AI, a cautious housing market, and a mixed bag of economic indicators.
Right.
Is there any good news out there?
Well,
what about Bitcoin?
Okay.
It had a bit of a rebound recently.
It did, didn't it? Bitcoin managed to bounce back from a recent dip, finding support around 91,791. Now, whether it can hold that level remains to be seen, but it's at least a glimmer of hope.
Okay.
For those who believe in the long-term potential of cryptocurrencies.
Okay, so a little bit of sunshine peeking through the clouds there.
Yeah.
What about bonds? How did they fare this year?
Bonds actually had a rather quiet year.
Okay.
Recording their smallest gain on record.
Right.
The yield curve.
Yeah.
Which basically shows the difference in interest rates between short-term and long-term bonds is currently at 28.83 basis points.
Okay.
And according to Bloomberg, many institutions are expected to be net short Treasury bonds.
Net short. Can you break that down for us?
Sure. Being net short means they're betting that bond prices will go down.
Right.
This generally happens when investors anticipate that interest rates will rise.
Okay.
Because bond prices and interest rates move in opposite directions.
Okay, so institutions are betting on higher interest rates.
Right.
But what if they're wrong? Isn't there a risk of what's called a short squeeze?
You're right. There's always that possibility.
Right.
A short squeeze happens when those who are betting against a particular asset, in this case bonds,
are forced to buy it back to cover their losses.
Right.
Which drives the price up.
Okay.
However, in the case of bonds, a short squeeze is unlikely.
Right.
Unless we see a significant shift in economic expectations.
Okay.
Towards deflation or a full-blown recession.
So it sounds like the bond market is also reflecting this overall uncertainty about the economy.
Yeah.
Speaking of uncertainty, let's touch on one final point before we wrap up.
Okay.
The jobs data.
Yeah.
I know there's been some debate about the accuracy of the official figures.
Yes.
Yeah.
There's always some level of debate surrounding economic data. And the jobs numbers are no exception.
Okay.
Bloomberg has argued that the official jobs data might be overstating employment by as much as 90,000 to 100,000 jobs per month.
Wow.
They've pointed to discrepancies between different surveys and potential flaws in the methodology used to collect the data. Okay.
It's a complex issue.
Yeah.
And there's no easy answer.
So how do we make sense of all this conflicting data?
Right.
It seems like we're ending the year with more questions than answers.
That's often the case with markets.
Yeah.
They're complex systems influenced by a multitude of factors. And there's always going to be some degree of uncertainty.
Okay, fair enough.
Yeah.
But are there any specific things we should be watching for as we head into the new year?
Absolutely.
Yeah.
The first couple weeks of January will bring some important data points.
Okay.
Keep an eye out for the JOLTS report on January 7th.
Right.
That stands for the Job Openings and Labor Turnover Survey.
Right.
And it gives us a more detailed look at the job market.
Gotcha.
Then on January 10th,
okay,
we have the December jobs report, which everyone will be dissecting for clues about the health of the labor market.
So mark your calendars.
Yes.
For January 7th and 10th.
Yep.
It sounds like those two reports could be pretty market moving.
Those are definitely two to watch.
Yeah.
They could give us a better sense of whether the labor market is truly as strong as the recent jobless claims numbers suggest, or if there are some underlying cracks starting to show. They could give us a better sense of whether the labor market is truly as strong as the recent jobless claims numbers suggest, or if there are some underlying cracks starting to show.
Yeah, it really is fascinating how all these seemingly disparate pieces of data,
right,
from consumer confidence to Bitcoin's price movements, all fit together to paint a picture of the overall market sentiment.
It is, isn't it? It's like putting together a giant jigsaw puzzle.
Right.
And each new data point is another piece that helps us see the bigger picture.
So as we wrap up 2024 and get ready to ring in the new year, what's your take on the market's overall mood? Is it cautious optimism? Cautious pessimism?
I'd say it's a healthy dose of caution.
Oh, okay.
With a side of wait and see.
Okay.
We have some conflicting signals.
Right.
Some potential headwinds on the horizon.
Yeah.
But also pockets of strength and resilience.
It kind of reminds me of that saying.
Yeah.
Predicting the market is like predicting the weather. You might get it right sometimes.
Right.
But you'll be wrong a lot, too.
That's a great analogy.
Yeah.
And it highlights the importance of staying informed, keeping an open mind, and being prepared for anything.
Well said.
Yeah.
So here's a final thought-provoking question for our listeners.
Okay.
As we head into 2025, if you had to bet on the dominant market narrative for the year ahead, would it be a soft landing?
Okay.
Where the economy slows down gently without a major recession?
Yeah.
Or something else entirely?
Ooh, that's a tough one.
Yeah.
It's really a question of which data points you choose to emphasize. If you focus on the slowdown in manufacturing and the potential for AI progress to stall, you might lean towards a less optimistic outlook. But if you put more weight on the resilient job market and the recent rebound in certain assets like Bitcoin, you could argue for a more positive scenario.
So much depends on interpretation and how things unfold in the coming months.
Right.
It's a reminder that market analysis is as much art as it is science.
Absolutely.
Yeah.
And that's what makes it so engaging. It's a constant exercise in critical thinking.
Right.
Evaluating different perspectives and trying to anticipate what the future holds.
To our listeners, we encourage you to stay curious, keep learning, and continue exploring the ever-evolving world of finance. We'll be back in the new year with more deep dives to help you navigate the markets and make sense of the data. Happy New Year.
Happy New Year.